All right. Good evening, everyone. So my name is Madeleine Gibson, and I would like to thank every one of you for taking the time to attend our first roundtable discussion of the year, the future of foreign business and foreign direct investment in China. The University of Edinburgh's China Future Society is one of the UK's only led student bodies dedicated to promoting understanding around Chinese current affairs, history, and culture. The China Future Society is an apolitical organisation, and therefore my role as mediator this evening is to ensure the debate is balanced and fair. All views and opinions expressed by the speakers in this discussion are their own and do not in any way reflect the views of China Future Society or the University of Edinburgh. When China introduced its reform and opening up policies in the late 1970s and joined the World Trade Organization in 2001, welcomed a surge of foreign direct investment, and it allowed multinational players to start operating within its Great Walls. Today, China is one of the largest recipients of FDI in the world and is home to a plethora of foreign companies. However, China is becoming an increasingly unstable environment for both foreign investors and businesses. For foreign investors, risks have increased following regulatory crackdowns on various sectors and a slowdown in growth. The crackdown in the property sector, resulting in Evergrande's current debt repayment difficulties, has signaled a potential shift in China's debt-fueled economic model to one focused on more sort of quality growth. For Western multinationals, data regulation, difficulties in obtaining visas for employees, and favoritism of local firms has made operating more difficult. Despite the state's tightening of control, China's new foreign investment law is designed to encourage foreign investment by relaxing some previous restrictions. Furthermore, China's quick recovery and continued growth following the COVID-19 pandemic has reinforced its economic might. Will FDI in China stay strong, or will unpredictable crackdowns on various sectors deter many investors for good? What does the future hold for multinationals in China? Will businesses and investors withstand the current unpredictable environment in exchange for the lure of China's colossal market and the potential for growth? I am pleased to welcome and host our panel today to discuss these questions and ideas. First, I would like to welcome back Daniel Widdicombe, an experienced international finance executive with deep experience in China. An Edinburgh alumnus, he served as the head of investment banking at China Construction Bank in London for over 10 years. Next, we have Dr. Ruzhen Li, who I had the pleasure of working alongside this summer. Fiercely intellectual, Ruzhen is currently head of advisory at Enhanced Group in Jersey and is also a guest lecturer at Brunel University in London. Ruzhen moved to the UK from China in 2002 and has had a successful career in investment advisory. Finally, I have the pleasure of welcoming Richard Cookson, senior investment professional with experience as head of research and fund manager at Rubicon Fund Management, chief investment officer at Citi Private Bank, and head of asset allocation at HSBC. Richard is also working as a columnist, often writing for Bloomberg. Each speaker has just over 5 minutes to pitch their thoughts on our topic today, following which we will move on to a moderated question and answer session. I invite our audience today to post their questions throughout the event in the chat box below. We'll be selecting a wide range of questions to pose to our panel during the Q&A discussion. Now it is my absolute pleasure to hand over to Daniel Widdicombe for his opening comments. So Daniel, over to you.
Thank you, and good afternoon, good evening, everyone. It's a pleasure to be here. I hope you can hear me. And what an incredible subject that we're here to talk about today. We don't have that much time to address the mysteries of China. I think we were asked really to talk about the background of foreign businesses in China, the current situation, and the future outlook. I think the background pretty much everyone will be familiar with, that foreign companies went into China in waves over the generations, starting with low-end manufacturing, moving up the value curve, focusing on trade and export, and then financial sector opened, high-end technology, and most recently perhaps consumer-facing luxury goods, education, entertainment, everything to do with domestic consumption. What's interesting is that the vast majority of FTSE 250 and S&P 500 companies have a presence in China, although of course there are some negative list prohibited areas. And actually the idea of a negative list is quite recent to China. They've gone through an ongoing reform process. So now instead of saying everything is off limits unless you apply for a license, it's the other way around. It's everything is open unless it's on the negative list. And the negative list has got shorter over the years, but of course there are lots of caveats. That's just an on-paper entrance to the market. The actual difficulties of competing and unobvious monopolistic behavior always exists in every country, actually. So what I find interesting is the the division between the political rhetoric, particularly in the Western media, and the mainstream issues that occupy the Western media, and the facts on the ground, as it were, in terms of actual business and trade. And this bifurcation has never been wider, because what we have is 70% of AmCham, American Chamber businesses in China, 60 to 70% of BritCham, British businesses in China, all saying in their latest surveys they're going to increase investment into the Chinese market. But how can that be? Everything is so uncertain. Well, regulatory goalposts are moving the whole time. Different sectors are being punished or attacked by the Communist Party. And of course, there's the broad Western moral outrage about various activities going on in China. So it seems like there's a real disconnect between what we're talking about and hearing about in the Western world and what businesses are doing. And I think that's always been the case, that politicians decree and businesses get on and do what they're saying. Let me give you a real live example of that. You remember the trade war between China and the US. You remember the US tariffs that were brought in to reduce the deficit with China. Well, that deficit 5 years on hasn't reduced, and trade volumes have increased. In fact, pre-pandemic, trade volumes were growing at a record rate between the two countries. So we've got to think in parallel terms about what we hear and what we read and what's actually happening. That's, I think, my first thought of the day. What's happening about the current challenges? Well, apart from some of the more obvious things, including a slowdown from a much larger base, because China's now, 2/3 the size of the US, and on a purchasing parity basis, it's probably surpassed the US in size. Quite apart from the red lines that the Chinese government themselves imposed upon the property sector. So despite headline media in the West saying this might be the collapse of the system, and it could be a catalyst to more pain, actually that's a self-inflicted adjustment to address over leverage in the property sector. And I'm sure we'll talk more about that in a minute. But I think some of the difficulties that China is facing, partly demographics, of course, because their population is reducing now, it seems, even though their latest census had a slight growth, but it took some time for them to come out with those numbers. I think the change in the pricing model, the shift in supply chain, they're exporting lower end manufacturing out of China along the Belt and Road. And also they're polluting industries. They can move out, like cement and construction. They're trying to move up the value curve, and that's always difficult. There are certain bottlenecks like chips. For example, microchips is a technology that China hasn't yet come up to international standards. And then the regulatory landscape with a political agenda behind it, whether it's to do with demographics and trying to improve the workplace for women, protecting children, making it more benign, the society, so that people don't work so much, so the population rate stabilizes. Who knows what the ultimate drivers are from the State Council. But I think foreign investors have been spooked. No one thought that private tuition and the flourishing listed market of companies would suddenly be shut down effectively as part of the crackdown on being overworked from a young age. But there are other regulatory changes that made a lot of sense in China. For example, the regulatory scrutiny on peer-to-peer lending, which was completely unregulated. It was very reasonable. And in fact, the regulators had flagged for a couple of years, hang on, guys, we're going to start taking this seriously. And yes, it might be that Jack Ma's rant against the regulators in October 2020, which derailed Alipay listing, accelerated the regulatory introduction of oversight on peer-to-peer lending. But that was long in coming. So I see that actually as part of China's reform that's continuing. What else would I like to say? Energy shortages have reared their head most recently globally. And this is a very big challenge for China because it's heavily dependent on coal, and it's not particularly high quality coal. So yeah, that's going to put back their green and environmental drive by a couple of years, no doubt. Political tension, of course, has unintended consequences, like the CIA is investing more in China by setting up a China hub, the China mission hub. So they're expanding. That's creating employment. That's just a kind of a side comment. Let's think about what China's going to look like in the next 5 or 10 years. What have we got to look forward to? And should we bother looking at a China market entry based on the weakening economy, the changing regulation, the moral outrage that it's quite selective, of course, but real as well on certain issues in China? Well, I think we're going to have a much larger economy than now, even if China reduces to a 1 or 2 or 3% growth rate over a 5 or 10 year period. It's going to get bigger. There's no doubt about that in my mind. And I think smart investors should align themselves to the core objectives of the Communist Party's 5-year plans, but also their longer term 2049 plan. You know that the CCP loves to have its symbolic timetables and anniversaries. So 2049, you're going to have a green and beautiful and prosperous Chinese society. And that's a good objective. In fact, their common prosperity, which is the drive currently, a sort of a backlash against the lavish extravagance of the billionaires and the increasing Gini coefficient gap between the urban dwellers and 600 million people in China who are still pretty poor, according to Wen Jiabao. I think that, yeah, that's very much like the leveling up policy in the UK. You know, we're trying to do the same thing. We're a prosperous, sated society where policies between the right and the left parties are actually very, you know, they adjust within a very narrow range. I think China's got much bigger issues in terms of poverty and wealth disparity, but at least they're trying to do something about it. You know, the social housing, a national health or a nationwide medical insurance policy, so on and so forth. They're starting to move in the right direction in certain areas. What are we going to look for then in terms of in terms of the next 5 to 10 years, where we can feel, yes, there may be shifting goalposts, but generally we're in the right direction as investors in China? It's going to be in high tech and pharma. It's going to be in robotics, if you can get in, nanotechnology, air travel, environmental, anything to do with the environment that a Western company can provide expertise to the Chinese nation. Food safety is a big one. Electrification of transport, anything to do with domestic consumption that doesn't stand out too much, isn't too overtly extravagant. So not luxury, but catering to the middle class, which continues to grow in China. So, and then any area that China feels it's not up to scratch internationally. And the best example of that is actually the financial sector. So the liberalization in finance greatly exceeds China's liberalization in other areas. The fact that foreign brokerages, foreign asset management companies can own 100% of their business in China now and start to compete properly is very positive. So it depends what area you're looking at. Chip technology, professional services. China is a vacuum in terms of the quality of professional services, legal, accounting, consulting. All of those areas could grow for foreign companies. But the challenges are great, and you can't go in with a short-term view, and maybe even a long-term view won't get you the outcome you desire, but it will be a very interesting journey. Thank you.
All right, thank you very much, Daniel. Now, Ruzhen, are you able to speak right now?
Yes, I am. Hi, everyone. I apologize first if there's some baby noise in the background. And my co-panelists have kindly offered to take over my baton if I have to unmute at some point. So my thoughts are very consistent with Daniel's words. I would say, yes, from the investor's perspective, what China is doing is mind-boggling, confusing, and puzzling. As recent as Q1, China was a darling of the market. It was outperforming even the US market. It's the first time ever in history. And then 2 quarters on, now everybody's talking about the very unpredictable policy U-turns that is made by the Chinese government. But I would say that if you have the although the sort of the journey has been quite roller coaster and a little difficult to predict, but I think if you can put your observation in the context of the blueprint of what the Chinese government is trying to achieve, both domestically inside China and outside China, it all of a sudden make a lot of sense. The blueprint is quite clear. Domestically, is inside China is restructure the economy from the labor-intensive and low end of the value chain to what they regard as a leading industry in future, being AI, being clean technology, being healthcare. And outside, they are trying to raise the political chips that China has. And if you observe, you would see, the ultimate sort of representation of the economy's dominance is the reserve currency status of US dollar. And you can see the Chinese government has been very quietly, discreetly to build up the levels of sometimes 2 steps forward, 1 step back, but over time has been built up the position of RMB and the international trading settlement system, and that is not going to stop. It will continue. So if you can remember this the policy inside China and the policy what China try to achieve in a global setting, you would probably understand what's happening in China in a slightly more sort of, oh, I can see what they're doing, that sort of that sort of feeling, rather than what did this coming out of. So from what I can see, in the past 5 years, in the next 5 to 10 years, I will see 2 opportunities and 2 risks. As the investment advisory position, we see a lot of the comments and movement from investment management industry, and how they've trying to get exposure to the Chinese market, being equity and being debt and being cryptocurrency, as well. I would say that the opening up of the capital market is inevitable, and everybody's talking about capital control. But if you read the news, you will see that the restriction of a foreign investor for foreign investment company to set up their products in China has been relaxed a lot more. And now we're even talking about not just the sort of blue chip A shares, they're also talking about private equity, talking about private debt, and talking about REITs as well. So the opening up of the capital market is inevitable, and the reform of the Chinese economy is getting deepened, and now the foreign ownership in certain industry is completely lifted, and now we've heard a lot of the international banks now opening up fully owned subsidiaries in China, rather than having to do a joint venture partner, find a joint venture partner in the past. So these are the 2 opportunities. And I would say the risk is, obviously, you've got a very clear blueprint of what China wants to achieve, but there's risk along the way. One, I would say policy error. I mean, if you look at what happened in the past 12 months, there was a whole series of policies that seems to be coming out of nowhere. But if you actually look into it, you will realize a lot of things they do is something everybody's sort of aware in a way, and it exists. The risk exists in US as well. For example, the antitrust. And a lot of things the American government and the American regulator want to do and it couldn't do, but the Chinese government can do it just like that. But the risk is, if we don't give enough sort of lead time for the international community to actually understand what they're trying to achieve, that will spook the investor. So that's one risk. The other risk is we're talking about Xi's third term. And as everybody said, she has so far has been a very benign dictator. It has been good news for China in aggregate. Now he's gonna almost certainly will be doing the third term. And then if you're familiar with Chinese politics, you will realize the reason to the Communist Party had a self-constraint not to have more than 2 terms is they learned the lesson from Chairman Mao. And what does that mean for Chinese politics going forward? I.e., is she getting too engrossed into his power? So far, I don't think that risk seems to be low, but it's quite such a strategic risk that cannot be ignored. That's what I've got to say.
Oh, thank you very much, Ruzhen. Thank you for your ideas on that. Right, carry on now to Richard. Would you please take it away?
Sure, thank you, and thank you, Ruzhen, and Dan. I'm a bit more jaundiced. I've been looking at China for a long time, possibly before most of you were born, which is rather embarrassing, really. I remember I was talking to the head of Matsushita in China in 1996, and it was quite unusual back then. I was writing for the Economist when it was vaguely interesting, and you can see we had a long interview, and he sort of said, we've done everything right. We've done technology transfer projects, we've stayed in there during Tiananmen Square, we've done everything they wanted, and they've made absolutely no money whatsoever. So I think quite a lot of, despite the fantastic headline growth numbers that you've seen and the size of the market, everyone's been rather seduced by popping money into China and finding, alas, that quite often they don't make money from it. Now, what you need to think of is why you do any sort of investment in China. Either it's for re-exporting out, so that was a big driver for the likes of Japanese companies or US companies to reduce costs, or you want to go into their market. Now, the problem with the domestic market, quite apart from the fact that the authorities quite often, as Dan was saying, they've shifted somewhat in the last few years to make foreign investment easier in certain sectors, but actually quite often they change the goalposts. You probably saw what they did with the education sector, which clobbered a lot of foreign investors and domestic investors, of course, in the last few months. So that this is a perennial problem. Lack of transparency in the rule of law, lack of transparency in the legal system, corruption. Any foreign businessman that goes into China will take another mobile phone rather than the business one because they're frightened of being hacked. So there's that sort of background that foreign companies have been working with. I think going forward, I think the prospects, although they're opening up in places, I think the prospects are probably worse because the growth rate is not just falling, it's plummeting at the moment. As I say, I'm rather more jaundiced than most. A lot of their growth in the last 5-10 years has been powered by massive credit growth via the property sector. So construction is about 15% of GDP. It's massive. So the problems you see in the property sector echo through the economy in a way that they wouldn't have done in the US or even in Japan in the late 80s, early 90s. And so you've seen huge credit growth. You've seen huge, property growth, asset price growth, the whole lot. And that seemed to be coming to a rather shuddering halt. I wouldn't actually be surprised if China was in recession even as we speak now. That's not because of Evergrande. Evergrande is a symptom of an underlying problem. And the underlying problem is that the corporate financial deficit, to go back to the sort of Wynne Godley type ways of looking at the world, was massively larger than it was in Japan in the late 80s. So you've seen huge borrowing by the private sector. Now there's a slight question mark about what's private, what's public in China. But what you're finding is that the interest cost for the private sector now exceeds nominal GDP, which is generally a very, very bad thing indeed. So you've got a government which is, I mean, to go back to what Ruzhen was talking about and the whole Xi stuff, it's really trying to batten down the hatches to make sure that everyone knows that they're in control. You've got a growth that is really plummeting hard, and I wouldn't be surprised if you started to see some rather panicky articles over the next few months saying quite how bad things are getting. You won't know that from the Chinese numbers, because the Chinese numbers, even more than other countries, are a complete fiction. So you've got to be really careful with this stuff. So I suspect that over the next year or two, some of the heady optimism about investing in China is going to come off the boil, much as it in Japan in the early 90s. In some ways, China's not as bad. In some ways, it's worse. It's got a similar demographic to Japan in the early 90s. Its financial sector its corporate deficit is way, way worse. But you don't have the extremity of asset prices you have there. And asset price deflation is a really bad thing for the economy as well. So I'm looking at this, and I'm looking at it from a CIO type point of view, from a risk reward point of view. And it seems to me that the risks in China, both political, both economic, and in terms of changing the goalposts, are going to be really profound for the next few years. What we end up with after that is anyone's guess, but it won't be a fast-growing economy. The demographics will take care of that. Shrinking economies generally have very low growth rates. It's not to say they're going to be negative, but it's like Japan, like Germany, like other aging economies, it's going to be problematic. That's what I have to say.
Okay, thank you, Richard. So now we're going to get into the sort of questions part of the discussion. So can I just remind everyone, if you've got any questions about what our three speakers have talked about so far, please put them in the chat box, and we will get around to answering them. So my first question I have for you, I guess it's either sort of to Daniel or Richard, because and Ruzhen actually, because Daniel and Ruzhen, you seemed fairly confident that China will be able to restructure its economy, and therefore it will be sort of attractive. It will continue to be attractive to foreign businesses and investors. Whereas Richard, you're taking a bit more of a pessimistic view. So, maybe Daniel, could you elaborate on why you think it will continue to be? Why do you disagree with Richard here? Why do you think businesses will continue to be in China, despite the potential for China's growth to become, much smaller?
Well, I don't know if I disagree with a lot of what Richard's saying. I think, and I also don't know if necessarily we've got heady optimism anymore. I think that maybe all the heady optimism, the wind was taken out of the sails of foreign investors maybe 3, 4, 5 years ago. It wasn't only the Trump-driven US-China trade war. It was also China's hostility on its borders. If you can't get on with your neighbors, there's always uncertainty. So it's not only India, it's obviously it's the bullying behavior against Australia and Canada, and the Taiwan problem. And then Hong Kong, of course, and the way they've dealt with it. They were very opportunistic and took advantage of COVID, and before that, took advantage of a small percentage of millions of peaceful protesters, and tarring them all with the same brush that they were violent or being egged on by foreign governments. So I think people have been clear-eyed about the risks in China for a long time. I don't know if there's heady optimism anymore, but I do think that the lure of a big market is too great, particularly for Western firms who are basically operating in almost ex-growth developed economies. So, and the problem with our economic model and capitalist economic model globally is that we're constantly seeking new growth. And that will always lead people to look into new geographies. And China's a good one. I think China does have some advantages as well as the horrifically challenging risks that we've talked about, particularly in terms of demographics. One is the size of it, because it's essentially, it's like 30 European countries. And so they do have some advantages in being able to move the focus of their investment, and because it's a dictatorial society, they can encourage people to move to different places, much like they did with moving Han populations out to Xinjiang and Tibet. That still has some legs, I think. Secondly, moving up the technology curve, they're still doing that quite well. It's a bit of a mosaic, but they've been very good. I was reading how Huawei has used ARM, which is, by the way, a UK chip company, chip technology company, using 5 nanometer chips based on ARM to introduce very new technology instruments in China. So there's some areas of the economy I think can flourish even as others do fall down. I mean, construction, the Chinese are masters at 5-year planning. We've got to accept that. And they're very good at centralizing construction and creating value in regions. So the Greater Bay Area is something that pulls together 10 big cities down in Guangdong province, including Hong Kong, Shenzhen, and Macau. There's definitely you can unleash some economic activity through allowing seamless interaction and trade and transport between those cities. So I think they'll do some things well, and they're going to face deleveraging challenges. And how do they replace that with what they want to do, which is domestic consumption? All of those factors, you have to be incredibly long-term and incredibly nimble. But I definitely agree with Richard that there are many, many firms that have gone into China and have never succeeded. And there's always that wish that you'll sell a single bolt of cloth to every person in China. And that's just a pipe dream. But there are very successful businesses that are Western run and Western owned as well. So, you've got to choose your battleground and navigate in choppy waters as far as China goes. Have local partners on the ground you know and trust. Spend a long time developing the relationships. Select an area that you feel might be pretty waterproof in terms of regulatory movements, and double your cost budget and half your revenue budget. And maybe you'll come closer to something like reality in future.
Okay, thank you, Daniel. I mean, so Richard, what would be your reply to that?
Yeah, I mean, I suppose it's the way to think about that is twofold. I mean, to pick up on Dan's points. One is, can you ignite a sufficient amount of growth for China as a whole, given the deleveraging and aging population pressures you're going to have over the next few years, and they could be really, really unpleasant. Can you do that by doing other stuff that you've not done or has yet to be done? Sure, you can offset it. I don't think I'm convinced that you're going to be able to do enough. But who knows? I don't know that there's a good answer to that. In terms of the sort of sectors that you would want to go into, sure, there's stuff that's going to grow, as there were in Japan. I mean, just look at robotics in Japan. It's been a fantastically good sector, and the Japanese have been very good at it. One of the problems in China, though, is that bits that you want to go into, in theory, in practice, you probably shouldn't go into, because you'll probably have your intellectual property nicked, or they won't allow you to go into it. So I think there's a couple of big questions there in terms of, even if those sectors are growing, whether or not foreign investors can take advantage of it, and maybe should they? I mean, there's a question mark there. I think just in terms of how big it is, yeah, there's lots of big markets. I mean, India will be another one. China always sounds a lot sexier, partly because what Dan was talking about. I mean, it's a great big 5-year plan. We're doing this, we're doing that. As a friend of mine put it many years ago, he said, think about China, he says it's all plot and no subplot. Whereas think about India, it's all subplot and no plot. India's a lot messier. Probably going to make more money in India than you are in China. but you can't tell the great big overarching stories in the same way. I just think the headwinds over China in aggregate are going to be very, very difficult.
Okay, and Ruzhen, do you have an opinion on this?
I would say, I think if you want to be a foreign investment and then operating in China is, I think a lot of people have approved it's difficult and it's not going to get any easier. But I think if you want to look at that angle as a capital investment, i.e. Rather than being operating in China, just participate with the growth of the company you invest in, I would say there was still a strong argument not to ignore China, because if you look at the world, where can investors put their capital? American stock market has been the way to go, but the valuation is very high, and how much higher can it go? It's difficult to say. You look at the second largest economy, it's something it's not something you should ignore. And in terms of from the positive side, why should investors still consider the Chinese market? I would say, as a domestic market, it has tremendous amount of productive labor, i.e. the demographics are not the best at the moment. But as a labor force, as a total labor market, the labor force as a whole, they're very productive. And that's why we are able to catch up with the rest of the competitors in a much shorter space of time in many sectors. And I think, and also there's a lot of capital, and that is been, savings from the citizens, etc., can be allocated appropriately into the critical sector that Chinese government believe require additional capital to grow. I would say it's the risk is definitely there, and people are a lot more sanguine about Chinese market now, which is a good thing. But I don't think it's a case where everyone just should turn their back to it.
Can I pick up there? I agree. But I think that's slightly a straw man, Ruzhen. In the sense of, it's a huge economy and it has huge markets. That burgeoning current account surplus that we have finds its counterparts in the capital account deficit. In other words, the stuff that you export, the widgets and cars and what have you, they receive, people have to invest that money in China, for one. Second, of course, so much more money is indexed now that any global investor will have a lot of money tied up in China. I don't think anybody's really saying that you're not going to put any money in China. The question is how much and what you might earn from it and where. There's also a very big difference, of course, between portfolio flows, which is what you're talking about. And by the way, I completely agree about the US stock market. It's wildly, massively overextended. The trouble with that, of course, is that actually when the US stock market goes down, everything else seems to follow historically, and it's not alone. So I think, one could quite easily say that, which is worse, well, I don't know, but that, certainly China's going to be higher beta. And I guess the last point I'd say is, look, there's going to be good things happening in China. I guess from my perspective, there's an awful lot of very expensive financial assets around the world. I'm not sure from a foreign direct investment point of view that I would be wanting to put lots of money in China at the moment. The banking system is being a bit crushed. The bad debts in the banking system are going up, very, very fast. And I think, the government, for all its undoubted virtues, is in something of a bind of its own making, because they've encouraged this huge credit spree over the last umpteen years. My sense is the chickens now come home to roost.
Okay, thank you, Richard. So something I just want to sort of touch on now is that I think there's like a bit of a contradiction between China's dual circulation policy, where it's promoting, focusing on relying on domestic sources for growth. However, it's also encouraging more foreign businesses and foreigners to invest in China, keep their businesses there. Daniel, what would you say to that? Can you explain that discrepancy?
Yeah, well, dual circulation, from my perspective, is it's geopolitical, great game strategy. So if you've been stung by the international community who haven't liked the approach you're taking domestically or internationally to various things, and you're the leadership of China. Your protective move, if you're playing the great game or playing Chinese chess, is to create the barrier that basically means you don't have to listen to those people and you don't have to rely on them. So they realized very quickly with the Huawei crackdown in the West is, well, Huawei doesn't produce its own chips. We don't have the right chip technology. We're reliant on Western technology. And I think that goes across many sectors, including financial services, where China's large banks are very, very immature and very plain vanilla and clunky and unsophisticated when they come out of China's borders, because in China they enjoy state protection and they're the 800-pound gorillas, and they come out and they're not sophisticated. Their systems, and I know because I've worked in one, their systems are well behind the curve, and they aren't prepared to be extremely competitive and take risk, because of being in a bank. That's the whole idea of being in a bank, is you assess risk and you put capital along with risk assessment. And so they've got a lot of learning to do. And I definitely see the import of and liberalization of sectors, allowing Western or international firms to come in, definitely fits their geopolitical strategic objectives, which is, let's fill the gaps that we're not strong at. Let's learn from the leading international players. And once we have those skills and knowledge in-house, then we'll domesticate them, and we may not need those foreign players anymore. I mean, there's that one channel of thought, but there's another channel of thought, which is actually China kind of sees its position as a large international player, and it wants to be big in trade. It wants to be an internationally respected country, but it doesn't have the skills in soft power, and it's squandered its soft power through what they call wolf warrior diplomacy in the last few years. It's become more and more strident, and they've made more and more, they've unfriended more and more countries. It's a real problem for China and its position in the world. So I think, you know, it's a very, very interesting time. And I'm curious particularly about Richard, because actually your views, which are much more, as you say, jaundiced towards China, are also quite mainstream, because you get the whole spectrum. And many people have been very negative about China actually for decades. And, you know, I graduated on June the 4th, 1989. I wonder if that date has any resonance for you guys. That was the Tiananmen massacre, you know, so I studied in China in the 80s. And when I graduated, lo and behold, the first thing that we had was the prospect that for the next decade, China would be completely closed to the world. You know what happened? 6 months later, China started to launch the Shanghai and Shenzhen stock exchanges, and it changed their destiny. So in other words, we have catastrophic events that we feel will shut China out from the rest of the world, be it mucking around with Taiwan or taking a firm control on Hong Kong. And we think it's all over. And then all of a sudden, it's like people forget about that. And the next year, there's something great going on. So it's so difficult to predict the future of China. We'll all be doing it in another 30 years, and who knows where we'll be.
All right, Daniel, thank you very much. I think we've got a question in the comments section for Daniel and Richard. How do you see China maintaining its leadership position within the world economy in the new age of decentralized finance? Is the introduction of the digital renminbi one of the ways it can maintain its leadership?
Shall I have a stab at that one?
Yeah, go ahead.
Yeah, I mean, you know, there's lots of things you need to do to the renminbi apart from making it digital. Having one rather than offshore and onshore and various incarnations is probably one of those. Look, the renminbi is important. It's growing in importance. It's you know, as I say, the counterpart to that huge current account, record current account surplus, trade surplus, is the fact that there are lots of bits of paper floating around going into China. So I mean, that is important. it's a very important trading partner for an awful lot of countries. Almost by definition, the renminbi is going to grow in importance. Your problem with China is that at the same time, they want to keep control of it. So you know, that's why they have the offshore and the onshore, and you know, so the CNY and the CNH. That makes it much more difficult. It makes it much more difficult because you still have restrictions about what foreign investors can invest in. So if you're trading these pieces of paper, you know, are you just going to be whacking on deposit? Are you going to use that as ways of, you know, investing in China? A lot of these things are actually quite difficult. And, you know, certainly its place in the world, well, as Dan was talking about, you know, the wolf diplomacy has not helped. I would probably slightly disagree with his view that everyone was put off by Tiananmen Square and all the rest of it. I mean, that was clearly a blip. I'm just talking about the straightforward dynamics of the underlying economy. I think the renminbi probably over time remains quite strong and probably quite stable. Again, you know, they've been very reluctant to let it float properly, and you know, it's a dirty float in the sort of market parlance, and it generally goes where they want to go. They want it to remain stable on a sort of trade basket basis, and a stable currency, I guess, is going to be one where people we're quite happy to put a store of wealth, with a few caveats that I mentioned earlier.
Okay, thank you. And it also looks like we have another sort of, I guess, vaguely related question about peer-to-peer lending. Daniel, could you pick up on that?
Sure.
Speak a bit more about the government regulations and how it will impact foreign direct investment.
Yeah, I think the question also included what was the reason about the Chinese government cracking down on that sector. It was about anti-money laundering and KYC, know your client concerns. It was also to do with proportionate risk, because the companies like the peer-to-peer lenders, companies like Alipay, were not themselves retaining any capital. They didn't have any capital base that was balanced with the amount that they were lending out. And so that kind of mismatch was quite concerning, because I think the size, the scale of their business was reaching the trillions of US dollars across China, and there was no counterparty of risk management. So I think it was essentially a Wild West, and there were no guarantees that that it could be managed in a stable way if something went wrong. So I think the regulators were right in that instance to impose stricter rules. I think that's interesting. I mean, just picking up on the renminbi issue, I feel that there's no prospect that China can become dominant in terms of its currency because of its political structure. What I mean by that is that the Communist Party of China is a control-driven entity, and it cannot lose control. And in fact, that's been more than highlighted most recently by Xi Jinping, saying that the party is east, north, west, south, center. It's everything. The party is everything. And so when they put directors onto the boards of private companies, you know, you have a Communist Party secretary or representative, you can tell that the party overlay is so entrenched with 400 million beneficiaries of the system. You've got 98 or 100 million party members, and then you've got their family members. You've got about 400 or 500 million people who are direct beneficiaries of the advantages of being in the party. So if you aren't able to countenance losing control, then there's no way you're going to liberalize your capital account. So if you don't liberalize your capital account, you're not going to have a freely floated and convertible currency. And so all the, for example, special drawing rights at the World Bank or the IMF and trade basket renminbi values are all based on this concept that China is a walled garden and it will not allow its currency to be truly freely convertible. I don't think it will happen in our lifetime, as long as the political construct remains in China, which it could do for a long time.
Okay, thank you, Daniel. So now, kind of following on from the topic of the sort of Chinese government's strong, influence on these kind of matters, I want to talk about their policy of common prosperity. And Ruzhen, I just wanted to ask you, in terms of common prosperity and, in light of the government's recent crackdowns, do you think what types of multinational firms are sort of most at risk of being impacted by these crackdowns because of their policy on common prosperity?
I would say the common prosperity is only part of this restructure of the economy. Just like Dan said, the P2P lending is the reason behind the crackdown. P2P lending is understandable, and the crackdown on the likes of Meituan, i.e. there were some social issues. I mean, the common prosperity also includes welfare. It just wants the society to be inequality to be reduced and the society to be more safer for people. And we talk about the issues around the DD, and that is because there were passengers being murdered by the DD taxi driver. So from what I can see, a lot of the policies does make sense, and the way it came about doesn't give investor a lot of confidence. The crackdown education is because the government want the bursary to go up, but the childcare special education is so huge, such a massive burden of household, they had to make it non-profitable. In a similar fashion to the crackdown on development, because the policy that the property is supposed to be living in, not to be trade or speculate. And that is also because a large part of the household income is going into the mortgage payment and debt payment, etc. So I think a lot of the policies are move away, reducing inequality, making China a fairer place. Is more on the sort of consumer end, i.e. e-commerce and online gaming, etc. And I don't think foreign investment actually ever had a strong hold in those sectors per se. So I would say more from the opportunity side. And if you want to prosper, you should really kind of direct your attention to places where the Chinese government strategically want the capital to go. It will be clean energy. It will be probably something to do with financial reform, for example. Now you can actually get more flexibility to actually participate to the banking sector, for example. So I will be more looking at the positive side. If you're not in those sectors where the government would like the capital to be directed to, you're not going to have the policy dividend, and your business prospect is going to be not that positive.
Can I pick up there? Sorry, just a couple of points to make. One is, I mean, completely agree. I mean, the interesting thing about China is it has one of the highest Gini coefficients in the world, which is kind of strange for apparently a communist country. In other words, the gap between the richest and the poorest is higher in China than it is in just about any other country on the planet. And largely that goes back to what Daniel was talking about earlier, which is that actually it's who you know and what position you have in the party and all the rest of it. On the bits where you should be going into, I mean, clearly, and again, Daniel also talked about this point, the financial sector. The financial sector is quite a difficult one. For China to open up, because of course, rather like Japan before it, it uses the banks to target lending. In other words, they're very there are private banks, but the big state-owned banks are there to shovel money into favoured projects. And it's quite difficult to open up the banking market and still have that very controlled lending policy. In a way, they're very like the Japanese banks in the late 80s. I know I touched on that earlier, but don't forget that Japan had 5-year plans and they did all of the rest of it. And when they came out into the big bad world in the late 80s, they were all AAA, and now none of them are, because they also were a bit useless. And for the same reason, which is they've not been required, they were not there to judge risk and reward. They were there to shovel money around the system. So I think it's going to be very difficult for China to open up its financial sector. Sure, they want the financial expertise, but going back to what the others were talking about, how do you open up expertise, particularly something as pivotal as finance, and maintain control? I think that's going to be a very, very difficult one for anybody to do. And just my last point here is, again, when you go back to the trade spats between Japan and China, I'm sorry I'm making such a big deal of it. It was all about opening up the financial sector, about insurance, about commercial banking, about asset management. And to be honest, I suspect that an awful lot of investors were quite glad with hindsight that they didn't manage to do that, because actually there were so many losses building up within the financial sector.
Okay, do either Ruzhen or Daniel, do you have any comments just to reply back to Richard on that, or not really?
Well, I think everyone covered that quite nicely. I saw some other interesting questions maybe on the chat block.
There's one about we've got one about the effect of the backlash against the 996 work culture. For example, lying flat. Do you know what impact this is going to have on China's economy, especially with an aging population?
Well, maybe lying flat will increase the birth rate. Who knows? But I mean, 996. I'm very glad to hear that 996 and see that 996 is kind of grinding to a sort of a halt. It's partly related to China's top-down Confucian social structure, that the boss basically tells people what to do. It's Confucian countries. It's right across Asia. I worked and lived in Japan, and it's exactly the same. The 996 means that people are being more productive, but then they're not nurturing their families at home. They're not rested. They're not consuming out and about. So there are pros and cons to that. Yes, if you're on a laser-focused march towards economic production, you might achieve more, although you do, of course, lose productivity if you're just hanging around and trying to wait for your 12-hour shift in the office to finish. So I kind of like the fact that there's a backlash, and now the Chinese government are thinking, well, okay, if we want our population growth to stabilize or recover, we're going to have to make it more attractive for people. They're going to have to spend more time at home, look after their children. We're going to have women have better benefits and maternity leave. There's a lot of things that they've got to do structurally in their society, and that's just one of them. Another one that's interesting you'll have read about is drinking culture, how there's been a bit of backlash against forced drinking in companies in China, because as everyone knows who's been around China, it's part of your business culture. Yeah, I think it's interesting that these are being aired in China, although the official line is that lying flat is a waste of time. Just, in other words, getting out of the rat race is something that should be frowned upon. But I think it's interesting it's getting a lot of airtime.
Okay, thank you. So I think on that sort of more positive note about the work culture becoming a bit better in China, that I think we'll call an end to this discussion. And I just want to say thank you very much to each one of our speakers for talking, for giving their fascinating insights on our topic. And I want to thank all of you for coming on this Thursday evening. So thank you very much. And maybe if I could just, our speakers could just stay behind for one more minute to say goodbye.